Hey, we are now going to present our 16th edition of Market Outlook, stock recommendations, stock reviews. Market Outlook would comprise 3 indices that we regularly do: Nifty, Bank Nifty, CNX Mid Cap. We are also doing sectoral indices. This week also there will be 2 or 3 sectoral indices, and then there would be stock reviews, and finally there would be stock recommendations. This week initially began with a lot of bearish overload. Last week had been a pretty damaging week. Market fell, but it was a truncated week. There was Independence Day holiday on the 15th. On 14th, Monday, there has been initially a sharp fall. After that, there was a good rise towards the end and a hammer line was formed. Post-market, there was this news of inflation of 7.44%, and vegetable inflation went up to 11% plus. This sort of created a panic. That's why on Wednesday the market began with a gap down, but market also realized that vegetable inflation that has happened is a thing of the past. It is that kind of inflation is a thing of the past. It is slowly coming down. So there had been quite a volatile movement. It would be very interesting when we study the Nifty in detail. Nifty this week has closed at 19,310. This is the 4th successive week that the Nifty has been falling. This time it has actually tested the 9-week exponential moving average at 19,287. The low posted on 14th of August was 19,257. That's the weekly low as well. Now the situation is such that if the 9-week moving average of the Nifty gets taken out next week, that is week starting from 21st August, then it will be very weak, and maybe we would say that the short-term downtrend could be morphing into an intermediate downtrend. Short-term downtrend, we call it short-term downtrend because the all-time high of 19,991 was recorded 5 weeks prior in the week starting 17th of July, and we are already 1 month from there. So chances are that we would see some kind of a negative price activity in the Nifty, in the general market as well. That's why the Nifty might actually fall. So we need to keep a close watch on the Nifty 9-week EMA, that is at 19,287. This will be acting as an initial support, but once it falls below that, then it would be pretty weak. Now we are going into the YTD chart. Nifty YTD chart shows that there is a kind of a doji formation on Friday, because the open was 19,301 and the close was 19,310. So 9 points between the two. This is on the chart. It looks almost as if it has closed at the open and close are at the same levels. So what we get here is that this suggests that since it has closed very near to the 50-day moving average, 50-day EMA at 19,264, there is a possibility of a bounce back early on in the next week. But what can happen? What can happen is this, that this will be resisted. any upswing now would be resisted around the 9-day exponential moving average, which is at 19,451. So 19,450 to about 19,575. This 125 points initially would be the major supply zone unless the Nifty moves above the 20 EMA of 19,575 and it posts at least 3 successive green candles. That is, close should be higher than the open for the next 3 days or so. We would not see any kind of significant recovery. On the other hand, at higher levels, expect more selling. On the downside, if the 50-day moving average at 19,264 and the erstwhile low of 19,257, which was there on say Monday last, if that last Monday's low is taken out, then it can slide down further. In that case, what I would like to point out here is that this is a zone that it would enter after it falls below 19,250. That is, only one full trading session is found between, say, the level of the level of 18,942 and 19,250. There is only one candle that you can see on 30th June, Friday. It was a gap up opening and it closed at 19,189. Again, the subsequent days showed a gap up opening and further up. So there is only one trading session that is found between 18,942 and 19,250. Much unlike the Bank Nifty. Bank Nifty, we see a zone in which it is getting support. That's why this time on Friday, the Bank Nifty was in a much better position compared to the Nifty, if at all there were to be a further fall. So Nifty that way is in a vulnerable position. Now finally we come to the 75-minute charts. In the 75-minute chart, this chart I have used to simply give you an idea as to how distribution is happening. If you look at the chart from, say, 24th July or 23rd July onwards, you will see that there is a considerable pressure at higher levels, and we see in this chart higher high, lower low and lower high pattern, which is a classic downtrend pattern. Of course, in the end, this support around 19,280 to about 19,250 held on for some time. We need to see whether it gets taken out or not. So the range between 19,300 and 19,250 would be very, very important for the next week. If 19,250 were to be taken out decisively, then it can fall much further to 18,942. You've seen that Bank Nifty is one index that has always, after May, June, Bank Nifty started performing badly. It is unable to move up beyond that 45,000 level, and Bank Nifty has given a bearish crossover between the 20-day and the 50-day moving averages, this death cross. Bank Nifty is struggling. Of course, it is also going with the market sentiment. So Bank Nifty's weakness continues. Bank Nifty, we start with the 125-minute chart. It exemplifies the support that the Bank Nifty is getting close to 43,500, 43,750 range. If you look at it, if you look at the chart, then you will notice that during the month of May and June, the Nifty, the Bank Nifty traded between 44,400 and 43,500. That is a 1,000-point range, and that's why you see some kind of a horizontal channel. When I used to refer to this as the projectile pattern, but from that projectile pattern, even the Bank Nifty moved sharply up after 20th of July. But now, while falling from above, Bank Nifty is getting good support, between say 43,500 and 44,000 range. The reason for that precisely is that earlier range where lots of trades have happened for nearly 3 weeks or so during this period. That's the reason why there is some support coming in. But that kind of a support, as I mentioned earlier, that Nifty is unlikely to get, because there is only one not isolated candle, one gap up candle that was there between say 18,950 and 19,250. This 300-point range had only one single Nifty green candle. That's why Nifty may not get much support there, whereas Bank Nifty is likely to get good support here. So this now we conclude the study of the 125-minute chart. We are going to YTD chart, the year-to-date chart for the Bank Nifty. Year-to-date chart for the Bank Nifty shows that this support that I am referring to is already found for the last 3 trading sessions after the Independence Day, that is 16th, 17th and 18th. On these days, the Bank Nifty got good support around say 43,850 to about 44,000 and 43,500 on the downside. So unless 43,500 is decisively taken out, Bank Nifty may be stalling. Bank Nifty may show seesaw movement, range bound movement, where buy weakness, sell strength could be done by the punters and scalpers, because for Bank Nifty 500 point doesn't mean much. It is a little over 1%. But of course the punters and scalpers can always play with such kind of little bit of movement in the index. If the Bank Nifty were to fall below say 43,456, then the next support is likely to come around 43,000 level. Precisely the Fibonacci that you can see, Fibonacci level, that is at 43,034, but roughly you should use 43,000 as the key support area. And as said earlier, that 42,500, 42,300 and finally 42,000 itself would also give good support to the Bank Nifty. So Bank Nifty, unless it breaks down below 43,500, it may be range bound. If it were to fall below 43,500 with a lot of selling, then it will go down. That's the kind of scenario that we envisage. And now we are moving to the weekly chart. In this weekly chart, what we find is that Bank Nifty also has been falling for the last, I would say that last 4 weeks, and again it suggests that already it has broken the 9-week moving average, which was at 44,473. Now this will act as a resistance if Bank Nifty were to move up. And we have also seen that Bank Nifty has been a weak index among the 3 that we normally study, that is Nifty, Bank Nifty and CNX. Now if it were to fall below 43,000, then as I said, now you can see that 42,500, and then there is a level of 41,600, 41,700, which is a major support area. So suffice it to say that only when 43,500 gets taken out on the downside, Bank Nifty may fall sharply. Otherwise, Bank Nifty may see range bound movement. If you like the presentation, if you did like it, press the like button, subscribe to my channel and share it among others. By the way, do not forget to press the bell button. CNX Mid Cap is the best performer. Till date, CNX Mid Cap has not really broken the 20-day moving average, 20-day EMA. CNX Mid Cap has not even tasted. We have noted that in our earlier editions. So how did the CNX perform? That needs to be studied in thorough detail. An almost 45-degree angle rise of the 200 unit moving average, 200 EMA, 200 unit EMA on the 75-minute chart, that shows very clearly that the CNX Mid Cap is making a good stride on the upside. It is not showing any kind of weakness. But what we see right from the month of August, that CNX Mid Cap, instead of moving further up in a 45-degree or 30-degree angle, it's actually showing some kind of a distribution pattern, in the sense that the high has not been much higher than 38,000 level, whereas it is in a narrow range bound trading activity that is happening, and it is trading between the 9 unit and the 50 unit moving averages. Of course, the Bollinger Band is actually giving an indication that there could be either an excursion on the downside or an excursion on the upside, because the constriction of the Bollinger Band generally suggests that there would be some kind of bust. Either it happens on the downside or on the upside. That kind of a situation is developing in the CNX Mid Cap. Now what you look at is the daily chart of the CNX Mid Cap. It is from the beginning of the year. It's the YTD chart of the CNX Mid Cap Index. Right from late March, early April, you can see that the relentless upswing that the CNX Mid Cap has been showing. Only significant thing that you need to observe and keep it in mind is the thing that last week the 4 sessions had been below the Gann angle. This Gann angle was earlier supporting the CNX Mid Cap. Now this Gann angle is actually acting as a resistance, and for the first time in 4 months we see, or rather more than 4 months, we see that the Gann angle is now acting as a resistance and not just a support. And now it is the 9-day exponential moving average which is giving support. So we need to be very careful about this CNX Mid Cap falling below the 9-day EMA, which is currently at 37,785. So that means a fall below 37,750 for the CNX Mid Cap would be a signal that this index is going to go further down. That's the situation now, and for the first time we see the chinks in the armor, and probably the retail people are not buying as much as they were doing over the last 4 months or so. So it is the first chink in the armor that we have seen. We need to see whether 37,750 gets taken out on the downside or not. If that were to happen, there would be further selling, and it can even go down to 36,500 to about 36,000. But that is something that we need to observe going forward. Now we look at the CNX Mid Cap 100 weekly chart. In this weekly chart, it is only showing that the same Gann angle has been tested, and there was a breach, but it closed higher. So we need to see the same thing. And here also the 9-week moving average, that is at 36,683. Earlier we were saying on the daily chart it was 37,750. Now we are noticing that there is another support at 36,683. So these moving averages, so the range between 37,750 and 36,700, this 1,000-point range for the CNX Mid Cap would be a big support area. If that gets taken out, then there is a possibility of a correction. Till now, the upswing, the intermediate uptrend that was there in the Nifty and the Bank Nifty, they have been broken. Correction has already started. But in the CNX Mid Cap, only for this week, the week gone by, we see 4 candles below the Gann angle. That is the first indication of a probable or at least a possible correction happening. Let's see how things pan out. If there is anything educational, please comment. Please write in YouTube. We are going to do the sectoral indices. Primarily among them will be the metals, IT and other indices that have performed well, and we also try to see which index is looking weak. We start our first sectoral indices review. We are taking up CNX Auto Index once again. There is a precise reason for that. CNX Auto is showing some kind of a correction as that is already happening in this, and there could be some kind of a correction, bigger correction setting in. Chances are there could be more selling here. What you look at is that again in a similar fashion, just like the CNX Mid Cap Index, it began right at the end of the March, end of the month of March, the upswing began. April, May, June, July had been pretty good. Only in the month of August, or a little earlier than August, we saw a top in the CNX Auto Index. It happened on 26th of July at 15,912. After that, it has started sliding, and now it is firmly below the 20-day moving average as well as the 9-day moving average. However, it is getting supported by the lower Bollinger Band, and there had been a hammer line after that. In this week we saw that CNX Auto Index actually it did show some rise. If you look at it, you find that the close had been at 15,391, and the 9-day exponential moving average is at 15,411. So it is closing very near to the 9-day exponential moving average, and if it were to stay above that, then there could be a further upswing. Instead of this correction continuing, there could be some further upswing if 9-day is decisively taken out. But one thing you must remember, if you see the chart, then you will notice that the 20-day moving average is actually acting as a resistance and a supply zone. So it would be better for us to actually become we can become bullish only after it takes out 15,500 level, because the 20-unit moving average is at 15,498. Unless that is taken out decisively, there will be no upswing in this CNX Auto. On the contrary, if it were to fall below the 50-day moving average of 15,133, or better still, if it were to fall below the 15,000 mark, then there could be further selling. So be very watchful. 15,500 matters a great deal on the upside, because above that it would be bullish again, and 15,000 level if breached, that would be the 15,000 level if breached, that would be a signal for a downswing. Now our second sectoral indices under review is CNX Metal. CNX Metal is in a short-term downtrend. Why do I say it's a short-term downtrend? Because you can see an evening star. This is on the last high that was made above the Bollinger Band. The high was 6819.85. It happened on 1st of August. After that, there is a red candle, and that was the evening star. And the evening star is generally a bearish pattern. And from there, we see that the index is actually come down below the 9-day as well as the 20-day moving average. It has now hovering below both the moving averages and very close to the 50-day moving average as well as the lower Bollinger Band. The last two trading sessions showed that it posted two dojis. That means the short-term downtrend might be in for some kind of a sideways, or an attempt will be made to take out the 6600 level, very close to the 20-day moving average level. But if it were to do that, only then be short-term bullish. Otherwise, a test of 6600 would mean that fresh selling in metal stocks can happen. So it's in a critical moment now for the CNX metal. Either it falls below the 6400 mark. In that case, it would become rank bearish because it would be moving below the Bollinger Band. And if it were to take out the level of 6600, then there is a likely possibility of some kind of an upswing, or at least testing the higher levels beyond 6600. In that case, some rally in metals might happen, but it needs to be seen first whether 6400 gets taken out or 6600 level gets taken out. With that view, we conclude the CNX Metal Index review. Our third and final sectoral index review is on CNX Infra. CNX Infra, again, around the time of the beginning of the month of August and the end of July, it showed two successive candles. One was a green candle which posted a high of 6122.60, and on 1st of August 6123.70, roughly around the same level with 1 point difference. So this is a tweezer's top kind of a formation in the CNX Infra. After that, there was a gap down, and CNX Infra is coming down now. There is a bearish crossover that is happening. Last day also it showed that the bearish crossover is on, in which we find that the 9-day exponential moving average is at 5997.45 compared to the 20-day moving average, which is at 6005. So there is only 8-point difference, but it shows that the 9-day has already breached the 20-day moving average for CNX Infra. CNX Infra suggests, and the RSI, if you look at it, RSI after the big fall early August, it has been going down. Now the final reading on last Friday was 53.68 for 14 RSI. This shows that this is a new low in 2 months' time in the RSI, and this suggests that there is a possibility of further correction. I would suggest that in infrastructure stocks, one would do better to at least take some money out of the table, because this also showed a huge rally from late March, early April till about the beginning of August. We see distribution, and there could be further fall, and this fall would be accentuated. This fall would acquire further gumption on the downside if 58.44, which is the 50-day moving average for this index, if that gets taken out decisively, then there would be a serious downswing, which might go down to something like 5600 level, if not more. So be very careful if it were to breach the 5850 kind of levels, that is the 50-day moving average level currently. If you like the presentation, if you did like it, press the like button, subscribe to my channel, and share it among others. By the way, do not forget to press the bell button, because that would help YouTube send you the notifications whenever we come up with another video. In stock reviews, we would not only discuss what we have given recommendations on, if there had been an interesting stock, whether that is worthy of a recommendation or simply it should be studied at the moment, we would take up that as well. Now you look at the Kotary Petro daily chart. On that, what you find is that throughout last week, as well as the week before that, there in total, right from the day of say 10th of August, Thursday, till 18th of August, there had been 6 sessions in which we see some kind of distribution. Kotary Petrochem has already moved up considerably. If you look at the Fibonacci level, then on the weekly chart, the Fibonacci level is much clearly visible. We go to the weekly chart now. There what we find is that there is a long tail doji as well as the 2.618 Fibonacci level of 108 is there, and the close today is at 107.80, and this long tail doji actually suggests loss of directionality. In this case, directionality was on the upside. It was bullish. That bullishness has evaporated from the stock, at least for the time being. And there is also this 20-week and 50-week moving average golden cross. Whenever this golden cross happens between 20-week and 50-week moving averages, generally the stock comes down, because this is the culmination of the initial bullishness. That's why some people who have actually entered the stock between say 70 and 80, they might be looking for an opportunity to sell the stock and book some profits. Maybe they would not exit fully, but they would definitely try to lower their cost of acquisition by selling part of their holdings. That is the kind of activity I envisage going to happen, at least in the near term. What is the range that I expect it to go down to? Once 108, it stays below 108, it is likely to seek the triple digit figure of 100, which is the 2.25 level of an erstwhile small range on which this Fibonacci is based. But the real target would be 1.618 times movement that is shown on the chart at 87.80. So there is a possibility that this stock may actually come down to something like 93, because there was an inverted hammer on the weekly chart in middle of July, and I see that the close was 92.60. So between 93 and 87, there is a possibility of this stock coming down to. But overall, this stock looks bullish. At lower levels, it should be bought. But if you buy now, then be prepared for at least a 20% correction from the current levels, because the recent move over the last 4 months had been so vertical that there is every possibility of a fall from here, and I want to keep you abreast of that kind of a development on the chart. Our second stock under review is Billa Precision. Billa Precision I have recommended, if I remember correctly, at least thrice. Once it was in COVID time, around when it was 18 rupees per share, and after that in between I have also recommended after it came down to 30 and then started moving up. Around that time I have also given recommendations on public media as well as to others through my newsletters and all. So Billa Precision is one stock that showed a great promise. The initial movement towards the end of 2021 and early 2022, when it moved up to something like 71 or 72 rupees, from that level it came down sharply to retrace to 30 levels, and then it has been a range bound situation between 30 and 50. Very recently it went up to 53. Now that you are looking at the weekly chart, you can see that after touching 53, the week before last, that is the week that started from 7th of August. That in that week it fell very sharply because its turnover has come down, but the margin, there has been an operating margin expansion, but the turnover has come down sharply. That was the reason for it to fall. Now, if you look at the YTD chart of Billa Precision, you can see that it fell pretty strongly after the publication of the results on 10th of this month. It has come down sharply, and there has been a lot of selling in this stock. This stock has still has that same promise because it has not broken down the 200-day exponential moving average around 37. Now it has come to something like 39.78. But the problem here is that this stock, this operating profit margin expansion, though, is a positive feature, but somehow at higher levels, the kind of selling that is happening, this time the nature of the selling is completely different. That is, there had been volume, there had been a sustained selling campaign. So what I would suggest is that this time, if you don't see it staying above the 20-day moving average level of around 48, then you should exit. Or else, if you find that it falls below the 50-day moving average of 44, or those who want to still stay put, do not stay put in this stock below 40. If it were to close below 40, again the 200-day exponential moving average would be broken. That time you should get out of it. If I were you, I would have said that the 50-day is a good enough level to get out. If you like my presentation, if you like my choice of stocks to review, and if there is anything educational, please comment. Please write in YouTube. Finally, there will be two interesting stock recommendations. Whatever the situation, we are trying to come up with two stock recommendations every week. There will be no exception this time. The first stock today is Cholamandalam Finance. Cholamandalam Finance is actually showing some bit of weakness. There is a possibility that over a period of time it might test its 200-day moving average, which is around 925. But prior to that, because there is an impending bearish crossover, bearish death cross between the 20-day and the 50-day moving average, that is likely. But when such thing happens, you will see hammer lines coming in. And in the last 4 sessions, that is the 4 trading sessions of the last week, what we find is that Monday, Thursday and Wednesday and Friday, these 3 days, barring the Wednesday, there had been hammer lines. One was an inverted hammer and the other 2 were direct hammer lines on Monday and last day, that is Friday. This suggests that there is a likely bounce back. This bounce back can happen because before a further fall, when 20-day and 50-day moving averages give a death cross, the stock jumps. I have a feeling that people actually pull it up to sell. Initially pulls it up and then sells at higher levels in a big quantity. That is going to happen. So those traders who are nimble-footed and they have a lot of dexterity in their position shifting, getting out and getting in, they can actually buy this with a stop below 988. At current levels of 1016 or so, you buy, and the projected level would be 1075 to about 1085. So This is a short-term trade. While short-term is defined as 3 to 5 weeks, but it can happen within a week. This move can happen, and after that, depending on the situation, you may take you may get out of it, or you may sell it, but don't buy at higher levels, because that could be a problematic thing. Our last and final stock recommendation, stock review, it is Eicher Motor. Again, here also I'm actually giving a short-term recommendation, in the sense that it is a 1:2 kind of a trade. It is going to go up, that's what I believe, because both the daily and the weekly charts have suggested that there is a possible bounce back here. There had been dojis, there had been hammer lines, and there is a persistent attempt to move up, climbing along with the 20-week moving average. That's why Eicher Motor, after a big fall 6 weeks back, now this is the retracement move that is going on. There is a possibility that this could be retraced almost fully, or maybe to a large extent of the total fall. So total fall 6 weeks back. So there is this thing on Eicher Motors daily chart, on the YTD chart, that is the last candle is a green candle, and it has crossed 9, 20, both the moving averages, and finally tested the 50-day moving average, now trying to move above that, also the Bollinger Band. So chances are that you will see some kind of a short-term up move in Eicher Motor. 33.49 is the closing price level. 32.39 is the stop loss levels. That is 110 points from the last close on Friday. That would be your stop loss. And on the other hand, on the upside, you can get 34.30 and 35.15. Do not be too greedy. If 34.30 is taken out, then 35.15 would be the next target, but in between there could be some selling coming in. If that happens, exit the position, because the general market is not very conducive for a bull run. So Bollinger Upper Band currently is at 33.87. So 33, once that Bollinger Upper Band is taken out, if the stock were to fall below the Bollinger Band Upper Band, in that case it is actually once again coming into the range bound situation. You can also exit the position. This is a buy attempt with specifically trading activity in mind. I'm not asking you for any medium term or long term investment in this stock. This is actually a short term play. Thank you for being with me. If you like my presentation, if you like my choice of stocks to review, stocks I recommend, and if there is anything educational, you should not only give a like, you should not only share it, you should also comment it, so that we get to know what you actually like, what you don't like. Be very frank in whatever you say. We want to know. Please